we purposely took an approach in 2024 that was conservative and diversified the business. By the end of the year, our technology platform revenue and financial services revenue now accounts for 47% of our total revenue. So we're not a lender anymore. We're much more diversified. And we're also moving the revenue that we're generating to fee-based revenue. In the quarter, we had a record amount of fee-based revenue, up 63% year over year. That will be the growth driver going forward. It was 40% of revenue in the fourth quarter, and we expect it to be the significant majority in the future. So moving away from higher risk, capital intensive lending to fee-based revenue.
That is Anthony Noto, the CEO of SOFI Technologies, talking about how the company has shifted their focus away from a more traditional style of lending to a more fee-based style of revenue. The question that this presents for all SOFI investors is, how will this change SOFI's business? There are a lot of different effects that this could have across their entire ecosystem, and that is exactly what we are going to discuss today. And we're also going to dive into how this could affect SOFI's stock price. And right now, a lot of investors are wondering where SOFI's stock is headed, because it's recovered around 60% from its lows back in April of $9.50. With a current stock price of around $15 per share, it's still well below its 52-week high of around $18.50, and it's definitely well below its all-time high of around $25 per share. However, right now, what SOFI is doing is they are positioning their business for the next 3 to 5 years. This is something that Anthony Noto has done consistently well over the last 5 years. He positioned SOFI to capitalize on a shifting market away from lending as interest rates increased and into the more money side of their business. And what he is doing now is he is focusing on fee-based revenue. In the first quarter of 2025, they put up a fee-based revenue of $315 million. That annualized would come out to $1.2 billion, which would be up from their $970 million in 2024 of fee-based revenue. However, what we have seen is their growth rate on this sector of the business is sitting at 67%. If they were able to just grow this revenue by around 60% consistently over 2025, we will actually see their fee-based revenue shoot up to around $1.5 billion. And the reason this revenue is so exciting for the company is because it's high margin revenue. Their EBITDA margin right now is sitting at 27% as of Q1 of 2025. The company is trying to target a 30% margin. That means that we could see a significant increase in their margin over the course of this year, especially if they continue to focus on this fee-based revenue. And here's Anthony Noto talking about how this side of the business works and how big of an opportunity this actually is.
Explain though, because I don't know if everyone knows, you did this deal with Blue Owl, which is one of the big credit providers in the country, for worth about $5 billion, right? How does that work?
Yeah, the way it works is they contract with us for a specific type of credit they want underwritten. We go out and generate demand for that underlying loan. We then fulfill that loan, and they take the loan away from us within a couple of days. So it's very capital light. We don't retain any credit risk, and we don't retain any capital requirements. It's something that we're doing on their behalf that we would not otherwise do for ourselves, either because we don't want that level of volume or that credit box. We actually turn down in a year over $100 billion of loan volume. We only fulfill about $20 billion ourselves. So that over $100 billion of loan volume, other people would like to have. We focus on a high-end customer that's 680 and higher, average FICO score around 750, average income around $150,000. But there are many of other people that have the need to invest in assets at a lower credit spectrum, and we're helping them do that, in addition to some volume in our credit box that's above and beyond the volume we want to do. So it's a high margin revenue stream. It's fee-based, and it doesn't retain credit.
And this is where the strategic approach that Anthony Noto has taken over the last few years is starting to pay off. Because basically what the company is focused on is growing their member count. Their member count has increased by 34% year over year in Q1 of 2025. They are now sitting just under 11 million members. And this is a huge opportunity because he talks about $100 billion of potential loan opportunities from their current customers. As they increase their number of customers, this loan volume or potential loan volume should increase significantly as well. And right now, this fee-based revenue makes up 41% of their total revenue. That is an increase from 2021 when it was only 26% of their total revenue. Overall, I think this is a very good approach for SoFi because what it ends up doing for the business is it provides additional diversification. What we have seen in the economy right now is some relative weakness, especially in the housing market. And if the housing market starts to pull back, SoFi is still going to be in an okay position because they aren't going to be holding on to a bunch of loans. Instead, they are only holding on to these loans for a couple of days and collecting a fee based off the generation of these loans. So overall, this approach from SoFi provides a lot of downside protection, but it also has the opportunity to provide a lot of growth for SoFi's bottom line. Current projections for 2025 are EPS of 28 cents. The low EPS is 26 cents and the high EPS number is 32 cents. 32 cents would be a double up of EPS from a year ago when they put up only 15 cents of earnings. However, what could be a lot more interesting is the potential that lies in 2026. Right now, analysts are expecting EPS of 46 cents, a low EPS of 36 cents, and a high EPS of 60 cents. However, consider a future where the Fed starts shifting their policy and they start lowering interest rates. A lot of consumers are going to be looking for new loans, either refinancing their home, getting a new home, or even buying a new vehicle. And all of this will allow SoFi to originate more loans and potentially offer or bring in more fee-based revenue. And we have already seen SoFi consistently beat their EPS numbers over the last year, beating by 60%, 15%, 36%, and then 94% in their most recent quarter. Consider though that a lot of these numbers are low, so even 1 cent or 2 cent beats turn into massive beats for their bottom line. So if you look at SoFi's numbers and the projections for 2026, the underperform and the inline performance are not very exciting. Right now, I'm assuming a 30 to 40 PE ratio, and that results in a stock price anywhere from $11 per share all the way up to $18 per share. So at the current stock price of around $15, it seems like it's trading at a fair value based off 2026 earnings. However, in my opinion, what is more realistic is SoFi putting up at least 50, if not 60 to 65 cents per share. And that is the outperform. Again, that involves likely the Fed needing to lower rates and a lot of consumers looking to refinance either their homes, buy new vehicles, buy new homes, whatever it may be, that actually drives them to look for new loans. And what that could result in, again, at a 30 to 40 PE ratio is a price target anywhere from $18 per share all the way up to $24 per share. So that means that right now, SoFi, based off my projections, has a potential upside of around 60%. However, that is considering a lot of things going right for the company. Right now, I have already built out my personal position in SoFi, so I'm not actually looking to add more to it. This is the YouTube portfolio. It's sitting around $65,000. And within this portfolio, I have 200 shares of SoFi. Right now, it's up around 155%. I'm very happy with how this position has played out. I also hold 100 shares in a Robinhood portfolio, so keep that in mind that I do own shares of this company and I am very bullish on where it's headed. I don't plan on selling out anytime soon. If it were to spike up to around $20, maybe $22 per share, then maybe I'd look to exit my position. But right now, I'm certainly happy holding on to SoFi. And the only positions that I have larger than SoFi are Google, Supermicrocomputer, AMD. AMD has been on an absolute tear. We are now up almost 60% on this position. We also have Microsoft, Microsoft, Adobe, and then under SoFi, smaller positions, we have PayPal, Abercrombie and Fitch, we have Alibaba, United Health Group, Palantir, United States Lime and Mineral, Estee Lauder, Apple, and Hawkins. But let me know in the comment section down below, do you hold SoFi and what is your price target for this stock over the course of the next year? Thank you guys so much for watching. If you did enjoy the video, drop a like down below and subscribe for more videos like this one. Keep in mind to never buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. Thank you again for watching and have a wonderful rest of your day.